position management. As you would see in this chart, success in trading is determined 30% by strategy, 30% by position management, and 40% by psychology of trading. In this lesson, we're going to discuss position sizing, or in other words, position management. And what do I mean when I say position sizing, and why is it important? Well, let's say that you have chosen any of the strategies that we've picked in our course and you master that strategy. And even if it gives you success 90% of the time, you can lose money in trading. If you decide to risk $50 for every trade and you take 9 trades with a ring of 1 to 2 risks to avoid, you could win $900. And then you decide to take one big trade and risk $1,000 for that trade because you think this is a good opportunity and you just lose money. Your account will be $100 in minus, even if you were right 90% of the time. As he mentioned in the book, Rockefeller once said, "In business, it doesn't matter if you are right or wrong. It is about how much money you make when you are right and how much money you lose when you are wrong." As I said in the beginning of this course, we need to treat trading as a business. So before every trade that you take, you need to determine 3 things. First thing is entry price. It is the price where you decide to buy if you are going long or to sell short if you are going short. Stop price, the price where you decide to get out if coin goes against your plan. And profit price, the price where you decide to take profits. Based on that, you need to calculate the number of coins based on your risk before you get into any trade. I always suggest to people not to risk more than 1 to 2% of their accounts. So for example, if your account is $10,000, you should risk no more than $100 to $200 per trade. If you're just in the beginning, you can even consider risking less. So if your broker gives you leverage 1 to 4, and on your margin account, you will have $40,000, it still doesn't mean that you shouldn't risk more than 1% of that $10,000, not $40,000. If you decide to trade a daily crypto sales strategy that you're going to learn about later, you need to consider how much is your risk for 1 hour. So if you buy your coin when the price is $10.20 and you put your stop at $10.10, it means that you are risking 10 cents. If you buy 100 coins, that means that you are risking $10. If you buy 1,000 coins, that means that you are risking $100. And that is your 1 hour or risk. When you want to take the profits, you need to make sure that you take at least 2 R or 2 times of your risk. If you are risking $100, you want to take profits $200 or more. And let's say that you have 100 trades a month with 1 to 2 risk to reward ratio, and you are right just 50% of the time, and you decide to risk $50 for every trade. It means that for every trade you win, you make $100. And for every trade you lose $50. You just need to do the math. Winning trades, 50 times 100, $5,000. Losing trades, 50 times 50, $2,500. At the end of the month, 5,000 minus 2,500 is $2,500 in profit. In case that you're right just 40% of the time, winning trades 40 times $100, 4,000. Losing trade 60 times $50, 3,000. At the end of the month, 4,000 minus 3,000 is $1,000. You are still profitable. Strategies that you're going to learn in this course had more than 60% of the winning rate. In the beginning, you could focus on the risk and reward that we give you with every strategy. Later on, you can experiment what fits you the best. As a bonus of this course, you're getting also our crypto position sizing file that will help you to easily count your positions while you are trading and investing. First thing that you need to do is to set your account size. For example, let's say that you start with $10,000. And I always suggest people to risk no more than 2%. You risk 1% out of $10,000. It means that you're risking $100 for every trade. This is leaving for you a place for a lot of mistakes and time to learn. So if you're risking $100 for every trade, let's say that you want to buy Ethereum that costs $4,900. And you put your stock immediately at $4,600. It means that you need to buy 0.33 coins. Let's say that you're buying Bitcoin that costs $55,000. And you put your stop at $54,000. It means that you need to buy 0.1 coin. What it really helps you read is when you're buying coins that are 0.000 something. Example, let's say that you're buying a coin that costs 0.003 and your stop loss price is 0.002. It means that you need to buy 100,000 of coins. The same goes with the shorting. Let's say that you want to buy a coin that costs $20 and your stop loss price is $22. It means that you need to buy 50 coins. You can always change your account size and your maximum risk.